But the reason y'all are here today is to CYA, which is kind of important in what we do for our heinies in terms of our financials and our audits. And I am so excited that we have Carter P.C. here. In my previous position, I actually had Carter P.C. employees doing our books at the Literacy Council. So I know the quality of work that they do, and I'm just thrilled that they're with us today. First off, we have Rufus Dollar. He's the tax manager for Carter P.C. and he's going to talk about 990 compliance and some policy best practices surrounding the 990, which is incredibly important. And then Levonia Reese is going to join us. She's the vice president and audit director, and she's going to do the who, what, where, when, how, and why of an audit. And I can certainly attest to she is phenomenal, as I've served on a board where she did our audit for us. So I think y'all are really going to learn a lot from two really phenomenal, very intelligent people. So I'm going to turn the floor over, and I believe Rufus is going first.
I'm going to pass these out to you, Rufus.
This podium because we're on film here. Good afternoon, and thank you very much for allowing us to come in and speak to you today. The point of my conversation is the Form 990, but if you've been involved with one of these before, you know that it's way bigger of a conversation than we can have in the time we've got allotted. And it's too big for a lunch conversation anyway. So what I wanted to focus on are two reporting aspects of it that are, to me, very important, both to the IRS and to the public. And that is the way professional fundraising services are reported on the return, and the way special events are reported on the return. Now, I've been in a lot of tax presentations where they tell you what and tell you what, and the forms and the instructions and all that, they go on forever. But you never really hear the why of the way things are. So I tried to figure out, why are things reported the way they are today? What has happened to get us there, and what's important? And this is why I think. In the 80s, there was a struggling nonprofit. It doesn't matter the name. They're very small, and they were in competition with a nationally recognized competitor in the realm of, they didn't do medical research, but they supported it, and they distributed information from it, that kind of thing. And in 1986, they were almost over. They were deciding whether they should roll it up or not. But as a last-ditch effort, the board got together and engaged a pretty big, at the time, fundraising company to come in and do a big push to bring them back to life. Now, from the position they were arguing from, the contract they engaged was a little one-sided. They, because the fundraiser was taking a pretty big risk, they insisted on a 5-year exclusivity contract. They couldn't hire anyone else during that time to do this kind of work. And that whatever list they come up with, or whatever process they developed from doing this work, they had the rights to it during that time and on. They would share it. And in exchange for doing that, the fundraising company would front the expenses for this big program. And it was signed. And 5 years later, and 80 million letters later, this program generated $28 million for this nonprofit at an expense of $26 million. So, but the organization was saved. And they didn't actually stay with the nonprofit. It didn't stay with the fundraiser, I'm sorry, after the 5 years. But when the IRS found out about all this, they just flipped out and they revoked the status of this nonprofit. They had so many grand reasons why. This is private endearment. This company, they said this company, because it fronted so much money when the nonprofit didn't have any, it was essentially a founder. Because it was its only source of income, it controlled the organization. The contract was not negotiated at arm's length, et cetera, et cetera, et cetera. And it went to court. And the good news for the taxpayer is the court just tore the IRS's argument completely to pieces. They said it had no basis in law. They said the IRS had an extreme lack of understanding of contract law. And if you were to apply the IRS's argument to what they were, to apply it to a logical extension, any vendor in the early years of a nonprofit will be in the same position. So that was thrown out. The organization got its status back, and everything was fine for them. But the IRS has a long memory. And the bit of sore losers too. So what I think has happened here is since that time, and this case was in 1999, even though it applied to the 80s, the factors that they took, they decided on in that case, they learned from that case, we can't really go after someone, we can't really revoke status based on these conditions anymore, it just doesn't work. But what we can do is we can ask questions about this, and we can insist on disclosure about this, and we can put it out into the public sphere and let the public decide based on these same criteria what they think about it, which makes lots more sense given the historic precedent of what a nonprofit is for. It makes so much more sense to put this information to the public and to let them come to their decisions. Now, that to me is the origin of the way that these issues are presented on Form 990 today. So the first part, the professional fundraising services. I will say that if your organization doesn't file a 990 for whatever reason, like if you're small enough to be able to file that postcard, or if you've got an exemption from filing a 990 for some reason, then you're fortunate. This doesn't apply to you. If you file the 990 EZ, this first part of the conversation doesn't apply to you, but we will in a second. And if you're a professional fundraiser and working with nonprofits, the point of this conversation for you is, I want you to know what it is you can provide to your clients to help them fill this out in the most accurate way possible. So the first part, professional fundraising services, what are those for tax? It's probably easier to say what they are not. Professional fundraising service for tax is not anything that the nonprofit's own employees or own officers or board members are doing. That it's really more of an independent contractor sort of thing they're looking for here. It does not include grant writing, just simple grant writing. And it does not include, I know nowadays you can hire services that can do automatic mailing and receive contributions for you and sort of route the deposits and do that kind of back office work. It doesn't apply to that either. It applies to people or organizations that have discretion over the fundraising campaign, who have created materials, who sort of drive the campaign, who provide consulting for the campaign. Those are the people who are triggered into this. If you pay people or organizations like that over $15,000 a year, then you trigger filing this form, and the following is disclosed. The IRS wants to know the name and the identity and the address of the person or organization that helped you, whether they had custody of the funds at any point. That question is not a trap. It doesn't have a wrong answer, but it does need to be answered. And it's important for a board to understand whether their professional fundraisers are allowing them to have that custody. If they do have it, you simply must just explain how that custody arrangement works on the form. It's in your best interest to explain it rather than to say yes and then leave that question. And finally, they want to know a little financial information. How much did the professional fundraiser earn for the nonprofit during the year? This question causes anxiety because sometimes the answer is I don't know or zero. It's sometimes hard to tell depending on what the arrangement is. If it's a consulting arrangement, maybe they just pointed you in the right direction, but you can't really say they earned us so much money. Or they did something that just had a pervasive effect over a lot of other campaigns. That's fine. That's understandable. Track it if you can. But if it's not possible to connect a professional fundraiser with a certain amount bringing in, that's fine. It happens. The second question, how much did you pay the professional fundraiser? And then the third column, the column people hate, is just the math on the difference. The net income or the net loss of that activity. At one time, they wanted you to compute a percentage column to work out like what percentage effectiveness each of these fundraisers did. And actually, this organization successfully lobbied to have that column stricken from the new return. It said it was, and I agree, it was completely inappropriate to hang a percentage on a fundraiser because there's so many other factors. It's way too simplistic. So they succeeded in getting that removed, but the total dollar column is still there. So let's see. Let's hit this talk about special events. And well, fundraising events is the tax term they use, but I will sometimes slip and just say special events. A special event is defined in, it's probably easy to define that as well by saying what it's not. It's not anything you're doing as part of an organization's exempt purpose. It's not a regularly carried on trade or business. And it's not a campaign that is purely solicitation, in which a donor does not receive anything in return for his contribution. That would not constitute a fundraising event for the IRS. What it does include are things like a dance, a dinner, golf tournament, an auction. Don't just think about things where a donor may get something physical in return. Event attendance is part of that too. So I think we kind of understand what an event would be. It doesn't necessarily have to be a one-day thing. It could be an ongoing or stretched out thing, as long as it's not part of your regular operations. You would consider it. Now, if all your special events for the year gross $15,000 or more, then you're triggered to file this part of the form, and you report on the 2 largest ones for the year, and then you just aggregate the rest as one. And they ask you to report it as the gross revenues from the event, less the contribution portion, I'll talk about that in a second, and then less all the expenses attributable for it. And now, what is the point of this section? This is my assumption of what it's for. I think this is for the IRS to do a little covert snooping on whether the organization is following the quid pro quo requirements. Is anyone familiar with quid pro quo rules? This is, quid pro quo is Latin for this for that. That's all that means. And a quid pro quo payment is when a donor gives a contribution to a nonprofit and gets something of value in return. Something that is more than a trinket or an intangible spiritual benefit. So churches typically don't have quid pro quo payments. And your coffee mugs, your keychains, your mouse pads, things like that, that's excluded. There's a small dollar threshold there where they don't count that. But event attendance is the big one, is the most common one. So attendance at a dinner, at a golf tournament, there's a value to that good time. And the example they always use, that's very commonly used by the IRS, is a patron pays $100 for a ticket to a charity dinner, and the value of the dinner is $40. Well, the person, the worry here, the chance for abuse, is that the person will deduct $100 off their own taxes as a charitable contribution, but they can't do that. They can deduct the $60, but the $40 went in here. That's just like a purchase of something. So the quid pro quo rules are on the nonprofit to figure out what that value of that return benefit is and report it back to those donors. The threshold for doing it in writing is $250 per donation. But in practice, it's typically a good idea that if you're having an event, to figure out ahead of time per ticket what that's going to be and print it on the ticket or print it on the receipt or have it widely available beforehand. So the way the IRS checks on you about this, the sneaky way, is they have you back out of your gross receipts the value of the contributions and report that somewhere else. This can make the event look like a loser. I've seen many times it look like an event lost money. It worries people, but it shouldn't. It's common. It's to be expected by the way they have you do the math. Okay. Now, are there any questions about those 2 reporting requirements?
Just, go ahead, Mark.
Oh, no.
Yeah, I just wanted to clarify, because this is, we receive some federal granting funds, and they're very specific about us reporting. But I guess what you're saying here, though, is that it really does have to be someone who is more professional helping you for you to have to fill out this form G. It's not just part of your, if you've got staff doing some of this, and right now it's very small.
Right. Well, if the staff are conducting the fundraising activities, then you're not engaging an outside party.
Right.
Then you haven't triggered that section, and you don't have to disclose those parties, because they wouldn't want you to disclose your employees on this section. This
Right.
is for unrelated contractors type
Okay.
thing.
Okay. That's good.
All right, I'm going to leave you with a couple of board policies. Oh, yes? Yeah, question over there. All right.
Yeah, that's okay. Yeah, I'm a grant writer, and I've noticed the past couple years, it seems like licenses that I had to get or contracts that I had to submit, those requirements have gone away in some instances. And I'm wondering if that's, some of it was that states hadn't clarified the rules about it, and now they have. And so I'm wondering if what's behind that, or if that's just a coincidence, or just from what you were saying earlier.
It's interesting. I'm not sure it's hard to say because every state's going to have a different reason for doing it. The IRS sort of follows suit they require you to disclose on the return every state that you're licensed to fundraise in, but that's in reference to the nonprofit, not the fundraiser. So the nonprofit can have a license to solicit in certain states. The fundraiser could have many more, but that wouldn't apply in this case, unless they brought them in somehow out of that. It's a good question. Possibly there's a push towards less regulation in this area, or maybe they are relying a little bit on federal reporting just to sort of do that legwork for them.
Mm-hmm.
It's possible.
Okay, thanks.
Okay. All right, I want to leave you with a couple of board policies that I think are a good idea in relation to fundraising. It's a good idea, I think, to have a board set a policy if you're going to engage an outside fundraiser to determine what part of that fundraiser's expenses are going to be reimbursable. It's one of those things that sort of can cause a logjam later on in the contract that was never really worked out, but it does have an important ramification for the nonprofit, because the expense that you pay is described as whether it's paid to the fundraiser or payments for supplies and other expenses. So who's bearing the cost of that should probably be, there at least needs to be a range worked out ahead of time before these contracts are entered into. House list of donors. Over time, a nonprofit can can develop a pretty nice donor list. Professional fundraisers will often contribute to the creation of those lists, so the question is, whose property are those? A nonprofit board should definitely have a policy in place that describes what they will and will not allow for the use of their donor list. And third, the board should really ensure that the quid pro quo requirements are met and that contributors are getting their written documentation back, because they're the ones who are going to have the problem with the deduction on their side if they can't substantiate what it is they're trying to deduct. And that written confirmation from you is, they would really need that in an audit situation. Quid pro quo is just an area where they would look at it from the event side, and the difficulty would be on you to keep their records up to date. Okay. Are there any questions on any of that? Well, thank you. I appreciate it. I'm going to turn it over to Levonia. She'll tell you a little bit about audit and such.
Thanks again for letting us come speak to you. Sometimes when we mention taxes and audits, people tend to panic, but there's no reason to panic when you have the right information. And so from the audit standpoint, the questions that I get from nonprofits typically are we required to have an audit, and why? What's involved in an audit? Are there other options? And who gets to see my audit? Who do I have to share it with versus who can I share it with? And so some of the information is on the handout. Usually for nonprofits, government funding is the #1 reason that a nonprofit is going to be required to have an audit. Whether you have federal funds that you expend $500,000 or more, that number is going to increase on January 1st, 2015 to $750,000. And that's federal funds. So there is a distinction for audit purposes whether you have federal funding or state funding. And state funding could come from a federal source as the originator, such as USDA or a Department of Health and Human Services, which is a lot of where typical nonprofits get the origination of their funds. So $500,000 or more will require you to have a single audit, and $500,000 or more of state funds will require you to have a yellow book audit. So that would put you into government auditing standards, And basically what that is, the government tells the auditors what procedures we have to perform. Yes.
Is that, if you, let's say you got a federal grant for $1.2 million,
Mhm.
but you're only getting a portion of that every year for 6 years?
If it's a federal grant, it depends on expenditures in one fiscal year.
Okay.
State funds is receipts or expenditures
Is that the fiscal year of the organization or the fiscal year of the government?
of the organization.
Okay.
It's going to depend on how you spend your money and how it's reported on your financial statements. And that does make a difference specifically to fundraisers, because accounting standards require you to record fundraising a little differently than you would in a for-profit world. When you raise funds, nonprofit GAAP requires you to recognize those funds immediately as revenue. And so your revenue will be in 1 year, your expenses could cross over several years. So that's a little different with nonprofit GAAP versus your typical generally accepted accounting principles for for-profit entities. Another requirement is, you can also see for Yellow Book, the state funds, it's received or expended. So state monies can be, if you receive it in 1 year, but don't spend it, you're still subject to those standards. So if you receive the government funding, either from federal or state purposes, make sure you're looking at that and reviewing that as you get close to your year end to see if you fall under one of those special standards that's going to require a separate audit in addition to your financial statement audit. Local funding also could trigger an audit. That could be United Way allocations, foundation grants, some charitable funds will require an audited financial statement. And sometimes it's just internal requirements. And those internal requirements, if it's bylaws, a board resolution, maybe it's to address a risk. That could be a one-time, if it's in your bylaws and the funding isn't there, you can amend the bylaws through a board resolution. Yes, ma'am?
Are these requirements North Carolina requirements, or does it matter what state you're in?
It does not matter which state you're in. These would be requirements for an overall audit. The North Carolina requirements typically come into play when you're talking about a local government, a town, a municipality, water sewer district. Those types would fall under North Carolina standards, and they have separate standards. To address a risk, sometimes maybe there's a risk of fraud. Maybe there's question that someone within the organization was not handling funds appropriately, and the board will make a resolution and decide to have an audit for 1 year or possibly 2 years or whatever to address that risk. What's involved in the audit process? And it really comes in 3 pieces. It comes in planning, it comes in field work, and it comes in reporting. The planning piece is where the initial procedures happen. The auditors are going to come on site. They're going to make inquiries. They're going to do fraud questions with management. They're going to read board minutes. Your auditors will request board minutes. That's one required audit procedure. And so they're gathering information to get that preliminary idea of what happened during the year in their mind. And then comes the field work. This is the fun part. This is the troops on the ground. You send in a team and they dig through your accounting records. They're going to look at bank recs. They're going to request account analysis, do certain procedures, pull samples, maybe look at payroll files. Depending upon the risk assessment, which happens in the planning, is what they're going to pull. Each and every audit should be different. We are required to have an element of unpredictability. So each year, we're not going to do the same thing that we did last year. Your auditors should be asking for different information on a rotational basis. That's not to say that payroll, which is usually the most significant expense for a nonprofit, that payroll will not be tested each year, because maybe the significance of payroll is enough to make it an annual testing area. But it should change from year to year to year based on those preliminary risk assessments. Reporting. Reporting is the piece that most nonprofits and the board is interested in. While the planning and the field work has to happen, the reporting is the end result. It's what you're going to see. That would include drafting the financial statements, drafting any compliance reports, accumulating any adjustments. If your auditors have to come in and make audit adjustments, those could be ones that get posted to the records. It could also be ones that are not posted to the records, but they are required to report those to the board of directors. That should be reported at the end of every audit. Presentation of the financial statements to the audit committee or board of directors, that should also be part of the audit process. If your nonprofit has an audit committee, they're charged with hiring, presentation of the financial statements, and approval of the audit. So that should also happen each year. From the reporting piece, we also, there's questions with nonprofits, who do I have to share my audit with? And it depends, really. If you are a general nonprofit that does not receive federal funds, then your major grantors are going to ask for those reports. And you should probably share those because your funding could depend on it. If you are subject to government auditing standards, if you fall into that yellow book report or a single audit, if you're a single audit, the auditors have to share your audit reports. It has to be uploaded to the Federal Audit Clearinghouse website after the audit with your data collection form. There's a 30-day requirement. It has to be uploaded within 30 days to that website. At that point, any of your funders will get copies of that report. That doesn't mean they're not going to ask you for a paper copy. They're not supposed to. They're supposed to be able to access it from there, but they do still ask for paper copies occasionally. As part of the reporting package, most nonprofits receive a letter to those charged with governance. That's a required letter, so you all should get one, and an internal control letter. That's the management letter. That's the internal control letter is the new terminology. And if you don't get one, pat yourself on the back, because nonprofits in general have segregation of duties. And when you get those internal control letters, if you're subject to government auditing standards, auditors are required to reference that letter in the compliance report, and that's going to prompt the funders to ask for that letter. If you have significant deficiencies or material weaknesses in that letter, your findings are going to show up in your audit report. And why that is important to nonprofits is that means anyone who requests to look at your audit is going to see what was reported in your internal control letter. That can be a big deal. Otherwise, you do not have to share it. The internal control letter and the letter to those charged with governance are restricted use by default. The auditors restrict use to those letters. You do not have to share them. If someone asks for it, you can decline. It is restricted use to management, the board, and any government funding agencies. If you do not have those, you're not required to share that particular information. Also, people want to know, what can we do not to have an audit? Are there other options, and what's the output? What's the deliverables that we get from other options? An audit gives you the highest level of assurance. You get an opinion on your financial statements. So they're going to say they are fairly stated or they are not fairly stated. You get that opinion. You get a full set of financial statements in most audits. While you can request to have cash basis statements with no notes, you can omit a statement of cash flows if you prefer. A typical GAAP set of statements is a statement of financial position, a statement of activities, a statement of cash flows, and full note disclosures, plus compliance reports if you're subject to government auditing standards. A review of financial statements. The report represents that there are no material modifications that should be made for the financial statements to be in conformity with GAAP. That's a lot of words basically to say They're materially there, but we didn't do the work to test it. The reviewing of the bank reconciliations, the detailed testing of payroll, all of that was omitted in the test work. You still get a full set of statements. You still get a balance sheet, an income statement, cash flows, and notes if that's what is presented in your financial statements. But there is limited assurance on the material accuracy of the financial statements. A compilation is also another option. A compilation, financial statements look exactly like an audit. Review looks exactly like an audit. Compilation, exactly like an audit. It even has a report. The report is no assurance. There is no assurance on the financial statements. And a compilation takes client information and puts that into financial statement form. You still have balance sheet, income statement, cash flows, and notes. Your financial statements look exactly the same. So if your funder is asking for an audit and you don't currently have an audit, or maybe the funding is not there for an audit, then you can ask them of other options that's going to get you the same results. If they're looking for financial statements, something other than generated internally out of QuickBooks or whatever your internal accounting software package may be, a compilation or a review will get you the same set of financial statements. The third option is an agreed upon procedures. And agreed upon procedures is you tell them, you tell the auditors what you want them to do, and they'll do it. Most of the time, agreed upon procedures is to address a risk. If there's a concern area that perhaps cash disbursements are not the procedures are not being followed, you can specifically request that certain procedures be performed just related to cash disbursements or just related to cash receipts. You name it, the procedures get done. You do not get financial statements with an agreed upon procedures. You get a report of here are the procedures that were performed, and you get a list of findings. So within that test, here's what was performed and here's the exceptions that were found in the testing. So that's the only of the four options in which you would not get a set of financial statements. And that's a lot of information. So we want to open it up to questions if you want to ask audit questions, tax questions. Yes, sir?
Your handout notes that a member of the public may request to review a copy of the audited financial statement. I'm wondering what requires organizations to release that? Is it state law or federal law? Or
It's neither. A member of the public, because you are a publicly supported charity as a 501c3, a member of the public could walk off the street to your office and say, I'd like to look at your audit. Typically, someone who asked that question is interested in giving you money.
But just so I understand, are organizations required to share the audit?
You are not required to share the audit, but they could ask
I see.
to review a copy of the financial statements.
Yeah, they can request your 990 back.
Sure.
Well, they can access that for free online.
Yeah, they
Yes.
can, they can get that online.
Yes, and most nonprofits have their 990 and their financial statements on their website. If they have audited financial statements, they're usually on the website.
I think for some of us that may be fairly new to fundraising, could you speak upon the amount of work it actually requires, the fundraiser? I mean, I've done this 3 years now with a very extensive audit, and it's incredibly time consuming, obviously great value. But, you know, I'm still learning every year about nuances of this, but could you all speak to that effect of just, you know, I understand why it's so critical, but maybe from a fundraiser's perspective, like how much work or some of the work involved?
Usually and I can speak from the audit standpoint, when we're auditing nonprofits, contributions are a significant risk area in each and every audit. And that's because nonprofits typically have a large volume of small dollar contributions. And in order for us to be able to express an opinion, there is a lot of work that would need to go into testing contributions, That could be done, typically what you would do is send confirmations for your large grants, for your large contributions. You know, you may have a dollar threshold of $10,000 or more. Where you're going to see the significant amount of time is, let's say the confirmations did not come back. And so now we need you to pull all contributions over $5,000, and we need to look at support for every single one of them. There may be 15. There may be 150. And so that's where a lot of the work would come in on the client part, is to provide the supporting documentation for those types of revenues.
And every year they ask for different things. I know that's part of doing their due diligence, but when you go into a nonprofit, do you have like 3 or 4 main criteria that you need from them? I presume it depends on what level of audit they want, but
It really depends on the funding source. If I had to use an example, someone who is funded 98% by USDA, then there's not a whole lot you're going to have to do for me, because I can get a pretty good comfort level with that USDA money that I can probably pull from a confirmation online. But let's say you're a nonprofit who has 99% of your revenue source in contribution dollars, and a lot of contributions are $100 a piece, then I'm probably going to need you to pull a good bit of information. And maybe this year I have you pull all contributions over X dollars, but maybe next year I have you pull me all the contributions for everyone that their last name starts with S. And that's just what we decide to do this year.
thank you.
Is there a time limit for using the same accounting firm?
For non-public companies, there is not. And so what a best practice from an accounting firm standpoint is to try to rotate a detailed reviewer so that the client gets the benefit of having someone, fresh sets of eyes on there. So your engagement team may stay intact for the most part, but for your sake, I hope it doesn't, because that means that the rotation, people are getting promoted, you're getting a fresh set of eyes from a detailed reviewer. We try not to have the same detailed reviewer more than 3 years. Any other questions?
I had
Yes.
a question just about software.
Mm-hmm.
And what you might recommend. We're looking at changing our financial software. We received federal funding, and we have 3 years to spend it. So we're dealing with, separate years, and we're having to keep up with that. And then, of course, we're getting contributions and grants and other things too. And we're on what I consider very cumbersome software called Peachtree. And looking at switch, and it's something that, that we've had in the organization for as long as the organization has been, and we're looking at switching. And I've never used QuickBooks, but can that manage something as diverse as what we're dealing with, or do you have some other suggestions?
We work with lots of clients that have lots of different software packages, all the way from QuickBooks, which is fairly inexpensive, it's easy to use, and if set up properly, there's very few clients that could not use QuickBooks as their software package, as long as it's set up properly. For a client that has a lot of cost centers, there are probably some other packages that may work better. Blackbaud is a really nice package. It's also quite expensive.
You're talking about from the financial side, not
Yes.
just the donor side. Yeah,
And
that's out of our price range.
Yes.
Right now.
But QuickBooks would work.
Okay.
And if you wanna ask some questions, we can email later, and I can just kind of tell you what I know about some of those various software packages.
Yeah. Well, we will probably hire a firm to come in and kind of help us kind of reset things up as well.
Okay, I'll be happy to provide you
Yeah.
whatever information I have.
Okay, great.
Any other questions? Okay, well, thank you again. We appreciate it.
We really appreciate you all, and maybe if anybody has some one-on-one questions, you'll maybe be able to hang around for a few minutes. Otherwise, we'll see you on October 15th. Have a great afternoon.